Welcome to the Regional Workforce 2009 and beyond. I'm sorry for my voice. It actually is better today than it was the last couple of days. We would like to thank everyone for coming this afternoon, especially our guests to the university and our conference presenters. There are 4 presentations this afternoon, including the keynote address by Mark Schweiker, President and CEO of the Greater Philadelphia Chamber of Commerce. There are also 2 15-minute breaks. Drinks and snacks will be available outside the hall during those breaks. At the conclusion of the conference, please join us for a cocktail reception back in the atrium of Bartley Hall. Our conference begins with opening remarks by Jim Danko, the Helen and William O'Toole Dean of the Villanova School of Business.
Thank you, Mary, and welcome everyone to the nursing school. I see the clever way we put the emblem out there to make sure that the business school got front billing on the podium. But indeed, we are in the nursing college today, and we appreciate their allowing us to be in this great facility that they just moved into recently. So, and I'm really delighted to welcome all of you here today. I want to thank some of the folks that have helped put this together. This was an idea that we started talking about a year ago when we were really looking at a number of things in our undergrad curriculum in particular. In various academic departments and areas, we're talking about things that they could do to really help push us and make sure that we were innovative and make sure that we were as aggressive as possible about connecting theory with practice. And the economics department talked about putting together an event like this. So it's really great to see it come to life. And I want to thank the chair of the department, Wen Mao, who oversaw this whole thing, and certainly Professors Mary Kelly and Dave Fiorenza, who both of the econ department, and their assistant who's out there, Kathy Costello, for working together with the National Association for Business Economics and Select Greater Philadelphia to put this very important event together for us. This conference is indeed a summit meeting of some of the region's top economic minds, thought leaders that have gathered here today at the university to talk about a plan for the employment future of the Greater Philadelphia area, which we know is a very important issue. We certainly at the Business School take seriously the mission of achieving and supporting faculty excellence, promoting ongoing curricular innovations, and providing a top quality learning environment, one that really works at connecting theory with practice. I'm not allowed to say a speech right now without mentioning that we are the number 11 undergraduate business program in the country by Business Week standards. So we're very pleased to have that. And I think thank you very much. Thank you. I owe him $10 for starting that, by the way. But we are pleased, and why rankings are always nice. I think the thing that it really underscores is that we do an outstanding job here on the educational side, and we have outstanding faculty, and we really do work aggressively to get thought leaders in different areas engaged with our students, and this is certainly an example of that. I want to mention some of the folks that you're going to be hearing from today and give my personal thanks and welcome these folks as well. Jim Diffley of Global Insight, which compiles quarterly economic forecasts for all 50 states for clients, including the U.S. government. He's going to explore the outlook and prospects for the regional labor force. Meg Shope Coppell, Director of Research, Philadelphia Workforce Investment Board. Claire Greenwood, Director of Policy Development, Select Greater Philadelphia. Tony Girafalco, Executive Vice President, Delaware Valley Industrial Resource Center. And Phil Hopkins, Vice President of Research of Select Greater Philadelphia, will assess emerging demand versus availability of talent in the region. You're also going to hear from Gary Smith, President and CEO of Chester County Economic Development Council, Robert Cormack, Executive Director of Bucks County Economic Development Corporation. Our own Dave Fiorenza is going to tackle the issue of human capital and public policy. And then later on this afternoon, we're going to wrap things up with our keynote speaker, former Governor Mark Schweiker, who's president and CEO of the Greater Philadelphia Chamber of Commerce. So I certainly want to thank those folks for being here today and add my welcome to them at this time. So thanks for being here today. And at this point, I'm going to turn it over to the former chair of the Economics Department and a great colleague and friend, Pete Zaleski. Pete?
Thanks, Jim. My job is to come up and to introduce the first speaker. Dean Danko did part of that, which makes my job a little easier, which of course that's the dean's job, is to make the faculty's job easier, right? So we'll start off with our first presentation today. Will be more of a more macro outlook about the Philadelphia region. Our speaker is James Diffley. Jim is Group Managing Director of Global Insights U.S. Regional Services Group. He has overall responsibility for the U.S. Regional Services. Since 1998, he has supervised the quarterly economic forecasts of the 50 states and over 300 metropolitan areas of the United States. He's made similar presentations as today, that he will today to such groups as the National Association of Home Builders, Builder 100, Real Share Real Estate Connect. So I guess suffice it to say, this man knows what he's talking about. So we're quite honored to have him. Jim did his PhD coursework at SUNY Stony Brook, and he has quite a lot of insight that he can share with us. And so the one thing I will say is if you do have questions, please save them at the end. We'll have a few minutes at the end of Jim's talk to handle some questions and answers before we go to our first break. So without further ado, Mr. Jim Diffley.
Thank you. And good afternoon, everyone. I am glad that, first of all, I'm not too pleased with the weather, as many of you are, and I hope that's where our other speakers are, trying to get through traffic. But I'm also glad we didn't schedule this on a day when on a time when Villanova was actually playing. Nobody would be here. We are a forecasting firm. That's our primary responsibility. So I'll start you off with a forecast that I'm sure you'll be interested in, and since it's a big concern on everybody. I've got Villanova going to the Elite Eight, but that's before they get beat by Pittsburgh. I'll also comment on speaking in the nursing school here, we're talking about the regional labor force and labor demand in general. It's hard to picture a field that's going to be in greater demand in the long term than nursing, so I think it's particularly appropriate to be here. But anyway, we are and I'm going to, as Dr. Zaleski said, do an overview of the economic outlook for both the nation, since it's so important now, but I'll focus on labor markets, even at the Philadelphia level. This is a completely unprecedented environment we're in, and have been in for basically the last 6 months. Wall Street, as we used to know it, has collapsed in many ways. We're talking about trillions, literally trillions of dollars in funds going to bail out Wall Street firms and related firms, and trillions of dollars of new national debt being added as we try to get out of this, what I'll term in a second, the Great Recession. I've never seen, and I'm old enough to have a pretty good experience now, I've never seen the bottom fall out of an economy, the whole U.S. economy, so quickly and so unexpectedly. It kept, as we went through 2008, the outlook kept getting worse and worse and worse. News was worse and worse and worse. As we saw, the implications of what really was happening, had happened on Wall Street in terms of the over-leveraging and selling of all sorts of exotic financial instruments and derivatives thereof, and the havoc that it's raised. For month after month, when I've gone to speak someplace, it's always been, there's worse news, I've got to tell you about this worse news. And what I've been saying is, and what we've been saying at Global Insight is that, as we watch the economy slide down, it's hard. We're looking for the bottom, but there's been no evidence of reaching a bottom. All we see is further and further slide down. Finally, a little bit of optimism here. It's too early to really read too much in this. There's a couple of pieces of news in the last week or two that indicate that, at least in some sectors, we may be leveling off. So that's what I mean by the bottom. We're falling down. we have to at least stop the fall, stop the bleeding, before we can even talk about coming back up. First, consumer spending, which fell about 4% in the fourth quarter, at least has been stayed at that low level, but hasn't deteriorated any further in at least the early figures we have for January and February, at least when you ignore automobiles, which still continue to fall. Second, housing starts, and the construction market was the real estate market was the first into the recession and the main cause of the problems we have, but by no means is the only problem right now. Housing starts, if you read the releases yesterday or the day before, seemed to jump up dramatically in February from January. Well, that was a little bit of a mirage based on a bad weather in January, much better weather in February. Really, we had February housing starts at the same level as they were roughly in December, but that's good news. Good news in the sense that maybe we are at the bottom of housing starts. We've honestly been predicting the bottom of housing starts every month or two in the future, all for the last year, but it keeps getting lower and lower and lower. Well, maybe we're finally at the bottom. So some little glimpse of hope. People on my staff this week pointed out that in terms of the home price decline for the last 3 months of 2008 and then as we head into 2009, there hasn't been an acceleration in the rate of decline as there had been through most of 2008. And they take that as good news, and I said, well, it could be worse, but it's hardly good news to say things are continuing to fall as fast as they were before. I will point out that it's that home price decline that remains a considerable risk, a very large risk in the economic outlook going forward, in the recovery, or further worsening of the recession going forward. Remember, the problems on Wall Street, right, have to do with the enormous losses on balance sheets owing to, at their start, the mortgage-backed securities, not only subprime-backed securities, but all mortgage-backed securities. And their value, which has been so hard for the government, Treasury Department to figure out, we'll talk about in a little while, continues to fall. And our further exposure, and the bank's further exposure to that fall, is directly related to how much further housing prices, home prices, come down. So it's very important to get that under control. That's a key source of the uncertainty going forward. All right, so what do we have in terms of our current outlook? GDP, right, the broadest measure of economic health, and real GDP I'm talking here, for the fourth quarter was measured at minus 6.2% annual rate. It's a shocking decline. We think it'll be just as bad, in fact, slightly worse in the first quarter, January, February, and March of 2009. That'll be 2 consecutive quarters of greater than a 6% decline in GDP. Business, what's happening? Business spending, and 2009, by the way, for the year now, this includes the first couple of quarters and the end of the year when we think things are, as you'll see, getting a bit better. The overall decline in 2009 would be minus 3.7%. So that's almost a 4% loss in real terms in economic activity. Business spending has been plummeting over the previous few months. It's very broad-based across businesses. At first, it wasn't in the high-tech sector so much, in semiconductors and software, and like now it is. Businesses are cutting back. You all know about how many workers are laying off, upwards of 600,000 a month for the last few months. But business equipment spending is down. Spending on new structures, non-residential structures, is way down. So the construction sector, which was already in panic because of the decline in residential construction, now has no activity, essentially no activity in non-residential construction going forward. World GDP this year in 2009 is on a pace, and we expect it to decline by about 2%. That's GDP as measured as if the whole world was one country. That's the first decline since when? First decline, any decline at all, since 1942. All right, totally unprecedented. Exports, now what does that do to us directly? Exports, the demand by foreigners for our goods and services, will decline 15% over the year, double-digit decline. It's been amazing not only how quickly the financial crisis spread from bank to bank, from Wall Street to Main Street in the U.S., but also how it spread so dramatically and so quickly overseas. Took us, frankly, by surprise in September, October, November of last year that the rest of the world, Europe in particular, was in as bad a shape as we were. And then adverse effects even for an incredibly fast-growing country like China. Housing, as I mentioned, still has not hit a bottom. Starts, prices, sales, home sales, the volume of sales are falling. The only thing rising, as you all know, unfortunately, is foreclosures. Actually, home sales are actually rising out west in California, Nevada, and Arizona, but that's all because of people selling foreclosed property or selling property to avoid foreclosure and the like. All right? There's no signs of recovery at all in the normal real estate market. One thing I'll comment on that, when you see reports about how much prices have fallen in California, it's about 50% in many areas in California, over 40% for the state as a whole, for instance. That's largely affected, we think, or significantly affected, we think, by the pressure of those short sales, as they're called, sales that are coming from properties either foreclosed or about to be foreclosed. You can imagine they're going at bargain basement prices. Right. Consumer spending, as I mentioned, was down 4% as we ended for the last quarter of 2008, but some possible good news there. There's a lot of talk about consumers, of course, and taking on excessive leverage, excessive debt, and that will end. You know, we've all got a rude awakening about how much debt we can, not only on Wall Street, but in households. Certainly true, but let's understand, there's been some misinterpretation, I think, about what that means going forward. There's a lot of talk, a lot of panic in the retail sector that, hey, shopping malls will be abandoned and go out of style, et cetera, because consumers are spending less. Well, consumer spending as a percent of income, we can expect to be reasonable expectation that it does go down, is lower going forward than it has been, and has been growing from the 80s to the 90s into this decade. But that doesn't mean that the rate of growth in consumer spending is slower than the rate of growth in the economy going forward, right? Once consumer spending is brought into line with income, all right, with the lower level as a share of income, it can then continue to grow as the economy grows, which would normally be about 3% in real terms per year. All right, so it's sort of a one-time decline and then growth going forward. You could weave more pessimistic scenarios, but you don't jump to the conclusion that because there's a pullback in debt, that consumer spending will be growing slower than the normal rate of growth in the economy. So we're not too pessimistic there. There's no bounce back in terms of consumers now suddenly, say when the economy improves in 2010, buying up all the things they didn't buy in 2009. No, those are gone forever, if you will, but spending can then proceed at that pace. There is one area of bounce back, though, in pent-up demand. That sort of counts as helps to put a natural floor on the economy. Some people ask, why do you think the economy is going to recover at all? You know, why don't we have something like the 1930s? Well, there's a couple of answers to that. One, the Federal Reserve is avoiding the mistakes of the 1930s. That's true. We think the Department of Treasury will as well, although, as you've heard, they're having a little trouble getting their plans together. But one thing that's happening also, remember, the rate of construction of new homes has now fallen well below the rate of growth of households in the U.S. population. Right? The rate of purchase of cars, now under 10 million vehicle rate per year, is under the rate of growth of the driving age population and below the replacement demand for older cars that are wearing out. Right? So ultimately, those two factors will push consumer spending up on how new homes and cars simply from that pent-up demand perspective. So it can't go on forever, at least in that regard. Small comfort going forward. Okay, deflation. Suddenly we're talking about deflation instead of inflation being a threat. If you saw this week, the CPI numbers were slightly up, a bit of a surprise. But we do expect CPI, the Consumer Price Index for the year, to be down minus 3.6% for this year. Two things are happening. One, there's weak demand in the economy. Retailers, as you know, are cutting prices, making deals. Hotels are cutting rates, et cetera, and so on. Cars prices are down. But of course, the big thing that's been driving inflation has been oil prices. And oil prices have had a violent up and down cycle, as we see. But we see oil prices staying down, about $33 a barrel by the end of the year. So we're getting down in more normal ranges. And that takes away the threat of inflation. What about the threat of deflation? Well, I think that's worrying a little too much. It's the least of our problems right now, but I'll let others talk about that if they like. All right, we are, because of the magnitude of the problem, engaging in an enormous federal stimulus, $700 to $800 billion. Notice on my slide, I point out too little, too late. Well, I hope not. But what happened while the stimulus was being discussed, say between the election in November and by the time the inauguration in January and then the release in February of the final plan and the approved upon plan, that the measured economic conditions, the economic data, and the economic outlook kept getting worse and worse and worse. So what looked like back in October and November, the appropriate size of a stimulus of $700 to $800 billion looked smaller and smaller compared to the hole in the economy that was taking place. And the one number you can see, for instance, President Obama continues to use the number that the stimulus plan is designed to create or save 3.5 to 4 million jobs. Well, when he first started talking like that, it would look like that would be the decline in, roughly the decline in employment owing to the recession. We now have the decline in employment from early 2008 to the bottom, which we think is late 2009, to be about $7 million jobs. So the stimulus, and those are rough numbers, there's no real way you can know it would create 3.5 to 4 million jobs. The stimulus is smaller than that gap. All right. So that's a little bit of a problem. Am I arguing for a bigger stimulus? No, I'm just pointing out that we have an issue. We think that without the stimulus, unemployment would reach 11% by the end of the year. All right? We already think now that unemployment would get up to just over 10%, but it would be another percentage point higher, and we think that the job loss would be another 2 million higher without the stimulus at all. Okay, let's talk about labor markets in the U.S. They've already, private employers, private sector, have already eliminated 4.4 million jobs, averaging over 660,000 for the past 3 months. And if you saw the release this morning of initial claims for unemployment insurance, that pace has continued yet another week. No surprise there. There's nothing comparable to the size of this decline. And it suddenly happened. There had been declines throughout 2008. That's why we termed the recession as having started right at the beginning of 2008. But the declines clearly accelerated violently with the financial crisis in October, November, December, and have continued into January and February. 1 million jobs from manufacturing, for instance. Hours worked have dropped. Not only are firms laying off people, but they're wanting to employ them less. The unemployment rate has now jumped above 8% for the U.S., and if we take the broader measure of underemployment, which includes those working part-time instead of full-time, or taking a job well below what they had before, 14.8% would be a more normal measure. And again, as I said, I can change this last slide as of today to 7 consecutive weeks where initial unemployment claims are above 600,000. So taking a look at this graphically, the unemployment rate, again, in just the last year here, notice on the bottom from February 08 to February 09, having been as low as under 4.5% 2 years ago, has now jumped way up above 8%. Amazing increase. And the purple bars in the negative direction are the size of the month-to-month employment declining since the beginning of last year, but accelerating the last 4 months, as I said. Absolutely outstanding. But the worst is yet to come. The red line measures, and with the scale on the left-hand side, measures job growth on a year-over-year basis, so percent growth in the number of employed over the year, going back to 1980, to show you the experience in the last couple of recessions. If I come up to 2010 here, and obviously 2010 is a forecast, here that thick solid line is deliberately put at 2009, current time, March of 2009. So anything to the right is our forecasted value for both rate of growth of jobs in red and the unemployment rate, which I mentioned in the second in blue. Over a 4% decline to be expected, and that's a one-year decline. So that's on top of the declines that had already been there, which are a little more moderate in 2008. If you go back over the years, though, the last recession, 1991, the red line only got as low as a little more than 1% of the workforce. Back in 80, 81 was the sharpest recession we had, the more deeper recession. A lot of you, most of you don't remember, but a lot of you remember, where job declines were 2.5%. I missed 2000, 2001, much milder if you notice what happened, but all of you remember in 2001 in particular with job declines approaching 2%, but only about half of where we are in this recession. The unemployment rate, similarly, the rate we're reaching now, 8.1%, was last achieved back in the 80, 81, 80, 82 recession, okay, where it did get above 10% for a while. We're clearly, we think, heading above 10%, so by the end of 2009, early 2010, we'll be above 10% for a brief time before we recover. Okay. And that's our recovery, we think, in the end of this year, thanks to the stimulus in part, but it also is going to take some untracking of credit markets. Credit markets have to be healthy again in order to get decent expansion, but the stimulus will help. So we'll hit the bottom at the end of this year, start to come up in 2010, but because financial markets are not fully recovered, even in 2010, we get a very weak recovery, weak rate of growth, weak rate of job creation in 2010. Then 2011, we finally have, if you will, a normal year of economic growth. Now, only one sector, and again, since we're in the nursing building, it's useful to point out, only one sector in terms of jobs avoids decline. That's how broad-based this decline. The reason it's so broad-based, and it's broad-based not only across sectors of the economy in terms of industries, but it's broad-based across regions of the economy. The whole country is being pushed down by national conditions. And that's education and health services being the bigger part there of growth. That's the blue shaded row there. You can follow the history, the actuals up through 2008 and then going forward with some growth 2010 through 2010. And then, and I've also pointed out the big declines in construction in the light shaded, or the light blue up there, shaded blue, not bolded. But negatives in every column if you run down the 2008, 2009 column. Or every row, sorry. All right. In this environment, wage growth is going to be very hard to justify in the business sector. Weak demand, inflation, so there's both lack of willingness or ability of corporations to pay increases, and there's also lack of competition in the labor market, or I should say excess competition from the laborer's side in the labor market. So wage growth we think is under 2% this year or next year, with construction, finance, manufacturing offering wage gains. And I'm serious about financial institutions, even though it seems to take a while for them to understand that bonuses don't have to be paid regardless of conditions. And then wages for sales workers as well. All right, who's going to experience above average growth rates in our forecast? Well, generally the professional, scientific, and technical services are well served. We do have 4.4% growth measured through the end of 2008. And hospital workers are in, again, reasonably strong demand, as I mentioned. But companies, from a company's standpoint, there's limited exposure on wages in terms of a cost factor going forward. Other cost factor, health benefits, well, we can all argue, and I won't go into it here, how the Obama health care proposal may change things. But that's a long and complicated story to come for sure. But there's only 3.5% benefit cost increase in 2008. So that was a good news in terms of inflation, in terms of cost pressures. The spending on drugs and health services actually does go down in a recession. There is clear evidence that people cut back. Can be dangerous to cut back, obviously, but there are cutbacks. Employers will also cut back as their premium costs to ensure their workers go up. Health insurers, though, after several years of strong profits, are under pressure. So I'll go on from that. The other big benefit cost pressure on firms is from pensions. All right? Pensions are especially interesting now because obviously with the stock market change, most of us have seen the value of our retirement funds hampered quite a bit. But employers, at any rate, will continue to have pressure on benefit costs that will offset some of the laxity on wage costs. But mild conditions relative to what's come before. All right, let's look at the region here. And again, as I said, I'll leave the other speakers to talk in much detail about the region, but I want to show you what our forecast is and what's been happening. I mentioned there's a broad-based impact from the U.S. recession. And as a result, Philadelphia, Pennsylvania, New Jersey have seen declines as well. So here I've shown you in terms of, just for the last year, the last 12, 13 months, the job declines, right, measured on the percent change over the last year in actual employment in the Philadelphia metro area, in the dark blue line. In Pennsylvania, the dashed red line, Pennsylvania performing a little better than Philadelphia as a whole. That's thanks to Pittsburgh, frankly, in western PA. Declining, but not declining so much. The U.S. is in the dark black line, and then New Jersey, which had started out from roughly the same position. If you go over to where those the January 2008 measures are, that would have been job gains from 2007. So in each case, slightly less than 1% gain. And both Pennsylvania and New Jersey were similar to the U.S. in that regard at that time. New Jersey falling much more rapidly. Why? Well, greater exposure both to the housing contraction and to the financial sector contraction than Philadelphia has. Notice also that the U.S. started falling well before Pennsylvania and Philadelphia did. All right? Why is that? Because Pennsylvania and Philadelphia were much more largely insulated from the collapse of construction markets. Yeah, house prices boomed here, but not so much as they did elsewhere, including New Jersey, but certainly not so much as California or Florida. Construction boomed here, but again, not so much as you saw out west. And so the contraction, the bubble bursting, didn't have as much of a downward pressure here as it did elsewhere. House prices have come down a little here, but not nearly so much as the rest of the country, most of the rest of the country. House prices are very important in terms of local consumer spending, local wealth, how local residents feel their wealth, of course. And then the construction sector itself adds jobs and income to the economy when it's thriving. So a more moderate decline, and I'll talk a little bit about how Philadelphia compares to the country over recessions as a whole. But one more point. The other thing to point out here, despite the lack of exposure in housing, relatively, and construction, the overwhelming factor in any local economy in the U.S. is what the rest of the U.S. is buying from it, right? There are national corporations here selling to worldwide markets, right? If demand is collapsing across the country, that's going to affect Philadelphia very strongly, all right, regardless of what the purely local conditions are. And that's why the whole country is being dragged down at such a harsh pace. Let's look at unemployment rates. The U.S., higher unemployment generally in the Northeast, and Pennsylvania, New Jersey, Philadelphia, the same, but rising above 8% as you see in the last month or two. The same colors as the previous graph. Philadelphia is in blue. Metropolitan area unemployment was only available when I did this graph earlier in the week, I guess, through December. We now have the January numbers, and it's going to be just above the 7% line for January in Philadelphia. All right. Not quite so high as Pennsylvania, or a little higher than Pennsylvania, sorry, not quite so high as New Jersey. All right, but rising, again, very rapidly, and this is just over the last 12 months to give you the upward swing. I'll show you what our forecast for unemployment in the local areas in a moment. But let's take a step back and look at how Philadelphia has performed over a couple of previous recessions. There was always a thought that historically a thought that Pennsylvania and Philadelphia, Pennsylvania more so than Philadelphia because of western Pennsylvania, were heavily dependent on manufacturing sectors. And in past recessions, manufacturing always had bigger drops than the rest of the economy. That was true not here, but true back in, say, the 1980-82, the large recession there. And there, the Pennsylvania and Philadelphia experience was every bit as bad, or worse than the rest of the country. But since then, all right, Philadelphia, especially, and even Pennsylvania to a large degree, have diversified their economies quite substantially. All right, and as a result, you see, for the last recession, first of all, 2001, 2002, the blue line, notice, not coming down nearly so much. I mean, correlated quite extensively with the U.S. economy, as I just argued it should be, but not coming down so much, a more moderate fall. In the current environment, going off the end of the page here, to finish 2008, again, not falling as much as the U.S. Notice the U.S. was growing faster 2004 to 2006 and tumbled off that higher rate right past Philadelphia to be underperforming Philadelphia region. And the same is true if I had put Pennsylvania up there. Back here in 1991, it's true that Philadelphia was worse than the U.S., but that was an interesting recession. It hit the Northeast a lot harder than it did the rest of the country. And so let me look at that a little. Let's look at, across the U.S. regions, how much employment, how many jobs were lost, percentage of the workforce here, in the 9 U.S. central census regions in this recession and the last 2 recessions. So you look at the red, the second line, MidAtlantic. In that 1991 recession, MidAtlantic, by the way, is New York, New Jersey, Pennsylvania. Lost 5.3% of its jobs in 1991. So far, it's only lost, well, no, I'm sorry, this is not just so far, this is our projection, by the way. Okay, so this includes further job losses that we project in Philadelphia. On the right-hand column, 4.2% is our peak to trough. From the highest level of employment to how much it falls, will be a 4.2% drop. Less than the 5.3%. Notice New England, almost a 10% drop in 1991. It was a very severe recession in the Northeast. The rest of the country was much more milder in terms of the impact. The 2001 recession was milder than both of them, turns out. Right? One of the interesting ways in which we phrased this recession as we're going into it in 2008 was, frankly, well, about mid-year, we knew a recession was coming. We said, well, it'll be about as bad. It'll be a mild one, only about as bad as the 2001-2002 recession. By the fall, well, it'll be as bad as the 1991 recession. By November, it'll be as bad as the 80-82 recession. Now it's worse than all of them. But that was the nature of the beast. Anyway, in bold, I've put here all the regions that have had, will have worse declines in this recession than the previous 2. And only the Northeast is excluded from that. Just FYI. Texas, for instance, which you'll see prominently on the next map, is one of the few that actually had a worse problem in 2001, 2002 than it's going to have this time. So we take another look, a map across the country here. All right, we already know we have job losses. Everybody's having job losses. They're going to continue through 2009, we think, maybe longer. And then we'll have a recovery. How long does it take before those job losses are regained or recouped and we get back to where we were at the beginning of 2008? The dark shaded brown are states, the very darkest shade, will not be there until 2014 or beyond. That includes New York and Connecticut suffering major financial sector losses. As you're not surprised to hear. The Midwest, Michigan in particular, which just continues to lose jobs, also has very slow growth coming out of the recession. The lighter colors recover much quicker. Texas, for instance, will be right back on track. We'll only lose it. We'll regain in 2010 what it lost in 2009, which is a very small amount. Pennsylvania, 2012, somewhat in the middle. All right, and then Philadelphia is roughly the same. To give you an idea of what's going on. What's our current outlook for Philadelphia? Again, using, I think, hopefully the same colors. In this case, the red line doesn't measure the rate of the percentage change in job loss, but I've got the job number over on the right. It's actually the thousands, almost 2 million, 1.9 million workers in the Philadelphia metro area. All right. So the peak, rest of the country, or most of the country as a whole, had its job peak in 2007 Q4. The end of the 2007 has been coming down. Philadelphia was actually gaining still into 2008, but started to fall then, and we think it reaches its trough at the end of 2009, having lost, well, you can do the math there, from 1920 down to 1870, about 50,000 jobs in the region. And then the upturn is the recovery, so that by the end of 2011, where I stopped the graph, we're back to where we were in late 2008 at the fall. What about unemployment here? Remember, unemployment in the U.S. is already at 8.1%. We think it reaches 10.1%. Unemployment in Philadelphia, we think, will be, this forecast, if I look at the spot, would be 7.3% in the first quarter of 2009, rising to about 8.7, 8.8% in the first quarter of 2010. I have unemployment rate always lags job changes, because what happens after recovery starts to occur, more people enter the labor force who previously hadn't been in it, now thinking they can get a job, start looking for work. So it looks like the unemployment, well, the measured unemployment rate has gone up, even though economic conditions are improving, because more people can't get jobs. So the good news is more people are looking. Anyway, that's why that lag occurs. And then coming down, we've got a very sluggish recovery. We don't get down back below 7%, right, until 2011. Obviously, that's a forecast. It's probably not as good as my NCAA forecast, but you know, of that type of forecast. What's going on that we're tracking closely in Philadelphia now? Big news. Big news in Philadelphia, New Jersey. You know, the very strong importance of the pharmaceutical industry for the whole corridor from New York through New Jersey down through Delaware. A lot of consolidation in that industry, which had been a growth driver for both Philadelphia and New Jersey for the last couple of decades, is in massive restructuring because of drug pipelines drying up, offshoring, a number of things. So two big events this year worth noting. One good news, one bad news. Sorry, one not so bad news. Pfizer is purchasing Wyeth. Wyeth, a very large presence here. Wyeth will lose a lot of jobs. What had been Wyeth will lose a lot of jobs in the Philadelphia area. There's no doubt about that. On the other hand, more recently, Merck, which is based in New Jersey with big operations in Montgomery County, is merging with Shearing Plow, which is largely a New Jersey firm. There'll be a lot of job losses there, but the understanding is from Merck is that most of the Merck losses will be from New Jersey operations, not from Philadelphia, Montgomery County operations. So that's the not so bad news for the region. So what's the, why does Philadelphia do better than the U.S. generally in this cycle? Diversified economy, and what propels Philadelphia going forward anyway? Diversified economy, a strong high-tech presence, strong human capital, educated labor force. The pharma industry is one aspect of that. Universities are another, obviously, including Villanova, of course. Moderate living costs relative to the rest of the Northeast and relative to a lot of the country, though it's interesting, the bursting of the home price bubble actually changes that equation a little. And it's actually changed migration patterns for a number of reasons. More people left Florida last year than came in for the first time in a long, long time, for instance. And that's because of the way the housing cycle changed. The weaknesses are, continue to emphasize two weaknesses for Philadelphia. One, the slow labor force growth. We don't have a lot of people moving in, generally slightly older population. And taxes in the city of Philadelphia, at any rate, stick out like a sore thumb for companies coming in. All right, with that, take questions. All right, take questions. Comments.
Hey, Jim.
Yes.
Let's go back to your map of the U.S. there.
This one?
Right. We see that New York is going to recover much more slowly.
Right. Because the depth of the decline is worse, yeah.
And the depth of the decline, and I'm going to guess, is that mainly due to the finance sector in New York City. So
my estimate is 65,000 financial jobs out of Manhattan, and I'm amongst the optimistic.
So if I was a business major and maybe now I'm a junior and I entered freshman year with dreams of a Wall Street job, what would you recommend to me?
Move to Washington. No, you know, that's the big uncertainty for the New York region, for sure, and finance in particular. Look, I think the demand for financial services will continue to be very, very strong. The same, and the reasons are the same as they've always been. We're a wealthy country, lost a lot of wealth, nominal wealth in the last couple of months, but there's still a lot of financial assets to manage and expertise needed to manage them. And so, long run, that'll be an important field. The compensation packages that most recently blew up in the case of AIG will most likely be changed. Most likely, I say. You know, it's not even clear how much that'll be changed, given the blowback you get from Wall Street from the criticism in Washington. You know, a lot of the banks are saying we'd rather give back the TARP money so we don't have to take your restrictions. Well, sorry guys, you know, but so it may not be as bad as you think, but you would expect the average compensation to go down from the very, very lofty heights. And I'm relatively bullish about New York long term for that reason in the financial sector. But you can have a much more jaded view, and there is a group in regional economics who think, well, the balance of power is shifting from New York to Washington. And if we talk about nationalization of the banks, for instance, that just reinforces that. I would think there would be, at best, be a temporary nationalization. Yes?
On a macro level, do you take into account what would happen if card check legislation passes, or if, for example, there's a military strike in Iran to stop the nuclearization of Iran and that interferes with oil? Does that impact on your analysis at all? Or
it would. We spend a lot of time doing such scenarios. Suppose X happens overseas, it affects oil prices, it affects, you know, export demand, et cetera, and so on, and run those scenarios. We do have a baseline assumption of that not happening, but on the other hand, we try to keep our baseline assumption politically realistic. So we do attempt to incorporate.
Your baseline is card check will not pass and there will not be an Iranian military strike. Is that...
I think that's fair to say, yes. Yes, sir.
There are many companies in the Philadelphia region that are very globally oriented. Mm-hmm. In fact, the openness to trade in the Philadelphia region is quite high, the levels of imports and exports. Have you looked at any of the trade data to see what the effect of the international financial crisis is going to have on trade in general?
Oh, well, in the short term, it has a very negative effect, right? I said exports are down 15%. Whether it's 15% evenly across the country is another matter. I'm not going to say offhand on that, or don't know. Don't have an opinion on that offhand. The governor, I noticed, Governor Rendell, announced the 2008 trade figures with great fanfare a couple of weeks ago, I think, and they were up rather substantially, double-digit rates. But if you look closely, yeah, they were up, but by the end of the year, they were falling sharply. And that's no reflection on the governor at all. But for the near term, and until we get out of this mess, trade's going to be restricted. Remember, the rest of the world is in decline as well, amazingly so. Yeah. One, you know, there's talk about trade routes being altered to the East Coast favor once the Panama Canal is widened and deepened, and encouraging Asian shipping coming instead of going so much to the West Coast to use that to an even greater extent than it does. A lot of trade into New York, and in particular, is already from China. It was already from China. So it's not as dramatic as you might think, but it will move it further in that direction. There's a question here, I think? Yeah.
What are you seeing for the PPI in the remainder of the year?
Declines, I don't have the exact number, but we do have a forecast. I can't quote that off the top of my head. Because commodity, I mentioned oil prices going down. The other thing I should have mentioned when we talk about inflation is other commodities went into free fall as well, at least relative to the bubble periods. There was a big commodity price bubble across many, many sectors. Yes?
I have a question for you. You mentioned one of the weaknesses in the Philadelphia area is the tax in the city of Philadelphia.
Right.
But many of the high-tech industries like Merck, for example, are in the Philly County.
Yeah.
So how much does the taxes really affect the region?
That's right.
Well, you're outside.
That's right. It's a Philadelphia city problem. It does, I take the broad regional perspective that what's good for Philadelphia City is generally good for the suburban area, although, there is some shuffling back and forth. It does help City Line Avenue outside of the city that Philadelphia has a wage tax, to be sure. So there's some offsetting effects, but you're good. I mean, that's a good point. Yes?
Yeah, this question addresses your opinion, and perhaps it's too technical, but we all know that, Washington and the Fed are having a lot of difficulty instilling confidence in consumer spending. Of course, consumer spending is affecting the forecasts. Do you think that one of the reasons why they're having such difficulty is because they really don't understand these complex derivatives such as swaps? And it's one of the reasons why people are having this big debate about this money going abroad when it has to go abroad because it's, one side of the contract has defaulted and they're hedging it using the FG money. So this is kind of technical, but I just wanted your opinion on it.
I can give, I guess, a somewhat pithy answer. I don't think it's that consumers don't understand swaps. I think it's that consumers are afraid that those guys they just paid big bonuses to in Connecticut don't understand the swaps they did. The point is the extent of derivatives and the extent of leverage on Wall Street was so enormous it got out of control, right? Consumers have no confidence that it's under control now. The one benefit, did I mention I think I had a bullet there, by the way. I think I must have missed it on the first slide. One of the negatives now, I think we've got a federal stimulus in place and it'll take time. I'm a little disappointed in how the shovel-ready projects all the governors said they had don't seem to be quite so shovel-ready. That's one thing. Second problem is the Treasury really hasn't gotten its act together in terms of getting whatever bailout we propose is coming forth. And that's an issue. That relates to that issue of confidence. So one of the things the Treasury is doing, I hope effectively, is sort of inventorying those assets, this whole stress test idea. What exactly is on the balance sheets, not only of AIG, but all the other banks involved. And so that then we can feel that we have our hands around how big the problem is. Is it 1 trillion, 2 trillion, 3 trillion? The answer might not be pleasant, but at least it'll be a step in the right direction. That help? I mean, I appreciate the concern.
We have time for a couple more questions.
You mentioned before that your advice to an undergraduate business student would be good luck. But do you feel like...
No, I'd say that. I'd always say that.
See, that almost will be
But do you feel that maybe there's a specific... And then you mentioned that the people who are working on Wall Street might not even understand the swaps that they were making. Do you feel that there's a specific skill set or maybe a knowledge of a different subject area that we should strive to acquire or understand before we leave our undergraduate institution?
Something tells me there will be very strong regulation of derivatives going forward. No, again, seriously, financial economics is very important, and financial markets will continue to be very important. In response to the question, I was being a little sarcastic about the credit default swaps and that, but let's understand, and this even pertains to things like mortgage-backed securities. The ability of the financial system to create new ways of borrowing money and diversifying risk was very helpful. It continues to be very helpful to the economy. It's very important in economic growth. It sort of took off in the wrong direction, or at least in a direction where no one quite understood the risk they were taking, or may not have. But I don't think that the lesson is that there are benefits to a smoothly functioning capital system. Yeah. Credit markets. Yes.
I was just curious again about that map, why Florida, California, and Nevada would be able to recover relatively quickly.
Oh, you know what? Part of that is that they're ahead of the curve, in the sense that they were seeing job losses well ahead of the rest of the country. So they're sort of first normally they have a bounce back in place quicker than the rest of the country does, basically. And I guess that's the best.
Wyoming is getting.
I used to avoid maps because somebody always zeroes in on straight. No, Wyoming had a very, very, very strong and booming time because of commodity inflation. That's ended. They're not going to. It's not that their losses are so large. They're not large. Okay, it's a little deceptive. But rather, their growth going forward will be relatively slow, and certainly slow compared to what it was. All right, that's really a commodity cycle for Wyoming, oil and gas and other things.
What do you see about commercial real estate regionally, short-term?
I mean, what's happened in commercial real estate? First of all, the office market in Philadelphia is better than most right now. So, I mean, there is room to expand, but things are on hold primarily because of credit conditions. I mean, both job demand is down, but as we said, Philadelphia have a weaker cycle, a more moderate cycle. So you can have prospects coming up, but credit conditions are holding things off. You have, Sierra 2 is waiting for who? BlackRock to make a commitment, I think. And some other people in the room know more about the details than I. The Comcast tower, though, did very well, surprisingly. I mean, there was worry about that being too much, and I'm not going to project the next tower being built, but I think, strong prospects, good prospects for a recovery, but not this year, right? Because of the general economy.